Morning, crew. Morning, everyone. Welcome to another Wealth Coffee Chat. Good to see a few of you jumping on now. A little bit less chilly than it was yesterday, so that's a good thing. Sun's out, hopefully, wherever you are. Nice looking day, lining up. Thursday, the 25th of August. Good morning to you, Kylie, Donna, Luke, Natando, Deb, Alison. Great to see the early birds up and at it already. Welcome back to our run through of the 5 plans, the 5 property wealth plans, or the models that we have. I thought I would sort of knock over the 5 models in one day, but you know, there's a little bit more to it than that. So it's a little bit of a run through this week on a few of those things. But before we dive into it, stick with us. We're going to do the 7 plans today. Some of you guys have seen the 7 plans before, but it's always good to repeat and refine and dive deeper and have a better understanding of what we're all doing when we might need to do it as property investors as we go along. So stick with us. But as before we get going, most of you know this already, but I'll do the little intros. That's my name right there. If you didn't already know, been property investing well over 20 years, coaching property investors across Australia and New Zealand. Actually, plenty of people from around the world, actually. We've got clients from everywhere. Singapore, Canada, Hong Kong, London. Pretty interesting. Mostly expats and stuff like that, but we do have some people investing from all over the world. Australia is a pretty good place to invest, to be honest. But for you and me, the idea of buying some great real estate in Australia and owning it as part of our wealth and our financial freedom and future is something that we all come and do. Anyway, we get together each morning, usually weekdays, about 10 past 8, and talk about that and, go through a few things. So welcome. Thanks for joining me. Great to see you. As always, if there's anything you ever want me to maybe dive into or have some, rhetoric on, leave a comment in the chat or send us a message. It's always good to have some feedback from you guys about what is on your mind, what might be concerning you, or what you might be interested in learning about. So there you go. Today, we're going to dive into the 7 plans. But what we have been doing, folks, if you're just dropping by today, let's say if you're here for the first time today, let us know in the chat. Let us know in the chat if you're dropping by or if you're a first-time viewer. It would be great to hear from you and see where you're at. Now, it might be that my... Oh, there we go. The iPad's up. Something was going on for a second. There we go. But, hey, listen, on, was it Monday? Maybe it was Tuesday. Anyway, one of the days recently this week, we all dived in and had a good look at the first part or the first model, which is the property wealth system. There's 7 levels to this process, starting at the decide factor, going through the levels of, getting your mojo on, really to the point where your portfolio kicks into the cash flow phase. And a lot of people, a lot of investors confuse the wealth exposure, the leverage, the acquisition phase with the cash flow phase. Now, there is a few people out there saying you can have both at the same time. To be honest, I don't know everything, that's for sure. Anyone tell you they do, they're full of rubbish. But in my pretty good experience, it's not achievable for the majority of people, and most people need a lot of cash, or a lot of equity, or a lot of earnings to have those outcomes. And there's compromises. You go to cash flow properties, often there's compromises in quality and growth. Anyway, that's not what I'm talking about today. whatever your strategy is, these conversations, these models 100% work, whether you're investing in cash flow real estate, whether you're investing in growth real estate, whether you're investing in quality, long-term, buy and hold real estate, even if you're investing in the world of commercial and retail, it still works. The conversations and the models still work, folks. You would just apply them, just tune them up for, the section that you're in as we roll along. Now, let's just see. Something's going a little bit weird today with my screen share on my little bit of equipment, but let's see if it works. Come on, you good thing. Anyway, yesterday we went through the 3 stages of wealth, the acquisitions, consolidated lifestyle. So if you haven't seen that one, go jump on it, folks. Anyway, this is good, doing a little bit weird. What I'm going to do is I'm going to stop sharing. I'm going to see what happens. Give me a moment. Anyway, anyone got a little comment or a concern or an issue or a question? Put it in the chat. I can talk for 30 seconds about that, or you can just hang around and wait for me to get my mojo on when it comes to my tech. Something's going on that's not behaving itself today. Hopefully, we should be able to rectify that momentarily. Some interesting things out there. I've got some supply data that I want to share with you a bit later on once we finish our 5 plans strategy stuff, and it's looking pretty interesting. Anyway, there we go. Maybe I'll just restart the thing. Anyway, today we're doing the 7 property wealth plans, folks, and part of the conversation is, how do we and where do we put these plans in the 3 stages? Okay, so today we're going to talk about, which plans have we got? There's a fair few builders having some challenges, Nintendo. You know what's interesting? It's interesting to see. This is nothing unusual when market conditions change. Businesses that are unprepared or had some practices that were built on, something, only going up forever, or only going in a positive direction forever. Those businesses often get themselves into a bit of heat. Same thing happened in the GFC. I don't know if you're around, Nintendo, about in that world. The GFC, sorted out a few, average practices as well. Well, we'll see. The thing is that, it's a very sad day for people to go out of business, and certainly people to have their properties, partly built. The reality is, Nintendo, though, those things do get rectified, 9 times out of 10 for the consumer. It just takes more time and costs more money, unfortunately. But I'll do a little thing on that, actually. That's a good one, Nintendo. I'll put that on my list to have a little yarn about. Morning, Adrian. Good morning to you. Trace, I see you dropping by. Good to see you, mate. Hey, listen, let's talk about these 7 property wealth plans. The acquisition plan. We talked a little bit about that yesterday. The number 1 plan. All of this, the rest of it, everything else is almost, it's not pointless, but it's severely hampered if you don't go and buy anything. All right? The conversation, team, is that we take our resources, our income, our equity or cash, and we spread it. We spread it into exposure to marketplaces and assets where we can get a return on it. The returns are rents, the returns are growth, the returns can be some tax deductibility and efficiency. That's not an investment principle, by the way. That's just a benefit or a bonus. You don't go buy something for a tax deduction. That's stupid. However, you should be claiming those deductions as you go, and if you're not, you're crazy. Right? The only people you're making rich, if you're not, are the government. I can tell you that. Anyway, there you go. Hey, Paul, Brendan, morning to you guys. Kevin, dialing in from Florida. Mate, it's always great to have you along as well. So listen, the acquisition plan. This is about buying stuff, all right? Buy your properties. Buy. And as we chatted about the other day, it's usually between 5 and 8 investments, okay? Can be more, can be less. However, you need to know what your plan is. Do you know your plan? It should be pretty simple. Put it in the chat for me right now. Do you know your acquisition plan? And it should go something like this. I'm going to buy 6 investments. They're going to be spread across 3 different states. I'm going to buy 2 houses, 2 units, and 2 apartments, 2 townhouses. It should go something like that. If you don't know your acquisition plan, which should be pretty simple, you should. But if you do know yours, put it in the chat. Put it in the chat for me, folks. And be involved. If you're driving and stuff like that, don't try and type, or you might be listening in a place where you can't type, but do it. What's your acquisition plan? Don't make it complicated. There's so many people caught up with analysis paralysis. Oh, I've got to get down to the last cent, $1, and it's inaccurate for $1. Yes, real estate is an inaccurate vehicle. It doesn't fit in perfectly into boxes. It ebbs and flows, but really at the end of the day, for most of us, if we get it within 5% or 10%, we're going to be okay. You got to have a little bit of, ebb and flow in this gig. All right. What's your plan? I'm buying 5 investments. They're going to be spread across 3 states, and I'm going to mix it up with a house, a townhouse, and apartments. There you go. Paul is going to buy 5 properties and hang on to them. Beautiful, Paul. And part of the strategy can be 2. Now, you guys know I say buy well, never sell, right? But there are instead of selling, I'm going to call it transform or shift, because that makes it better. All right. So you guys know I work with Andy Fenton, one of the best wealth planners on the planet. And when we put some strategies together, sometimes owning a property in your own name to begin with is very, very, very effective for the first maybe 10, 15, 20 years of ownership. But later on in life, it becomes ineffective. So we would sometimes then transform that one or 2, transform it from ownership in your own name and roll it and transform it into ownership in a better tax structure. Now, that's just sell that property and buy another one in your super. But that makes me feel better because I'm not telling you to sell it. I'm telling you to transform it. Anyway, there you go. It's disappointing that you can't send it over. However, I'm taking a long time to talk through these 7 plans today. Yeah, 10 years and now consolidation phase. Nice, Paul. Yeah, beautiful. It has to be simple, team. It has to be simple. I love that, Paul. Brendan, he's going to do the residential real estate first and then some commercial for cash flow. Awesome. And I love that, Brendan, because your acceleration strategy, because you've added an acceleration strategy now, is with commercial, right? So, and often with your acquisition plan, people get them mixed up. If Brendan was going, I'd go for commercial first, and I don't know Brendan's situation, so maybe he's got the resources and the capacity and the risk level to do commercial first. But acceleration first, higher risk deals first as an investor is not a very good idea. Okay, so there you go. Allison's acceleration strategy, dual purpose. All right. Now I'm sure Allison's saying, okay, you could furnish them, you could Airbnb them, you could accelerate the rents in that way. That's the level of acceleration. That's the level of acceleration, right? So, there you go. So nice, awesome. Luke, 2 houses, Victoria, 1 apartment, and a house in Queen. Beautiful. Industrial property and self-managed super. Industrial commercial is in your super is extremely effective. And that's actually one of the types of properties, folks, you can transfer from outside and put into super, and you don't have to sell it. If any business owners are sitting here right now, you need to come and have Andy Fenton and I are doing this program called the Exit Plan for Business Owners. It's coming up in September. So if you're a business owner listening in, keep an ear out for that one. It's going to be absolute cracker for you guys. Business owners are able to use some more strategies because effectively they're able to manage their incomes and cash through company and trust structures very effectively, where many of us as PAYG earners are restricted, but it's still powerful, folks. You guys know this. Anyway, shivers. I'm not even going to get through this all today. Anyway, too much yabba, Jason. Right, a lending plan. You guys know you need a good lending plan. Not only a lending plan for acquisition, a lending plan for consolidation, and a lending plan for acceleration. Okay, so there's 3 plans within a plan. There's 3 plans. 1, 2, 3. Do you know the 3 plans and what you need from them? A property management plan. You know, what does that mean? You know, do you know when you're going to renovate the property? Okay, you know, at year 7. You know, how can you, like Alison might be alluding to there, how can you accelerate your income through a management plan? Well, you know, furnish it, short-term let it, et cetera, okay? Those sorts of things. So, and also, you know, keep your vacancies low and get your rents up, okay? Where's your plan? What are you doing with that one? Yeah, listen, I didn't even get through half a plan on Monday, did I? Gee, I was biting off more than I can chew. I was feeling very positive after my holiday. A few days off, I'm thinking, oh, I can knock this over. But there you go. What I might do, Trace, I'll dive into some lending plans. Actually, I'll extend our little series here. Our tax minimization plan, folks. You know, do you know exactly how you can stop giving so much bloody money to the government, right? A debt reduction plan. When do you deploy that? Okay, when do you deploy that? Your financial plan, really at the end of the day, this is about protection and underwriting the risk that you're taking for sure, but also the efficiency of how you receive money and capital and cash into the future and wealth acceleration. You know, Brendan, Alison, you know, just talking about their future acceleration plans as well. Going to roll into commercial. Alison's going to maybe, you know, furnish and short-term let some of her properties. So there you go. Hopefully that makes sense. I rushed through those things, but now, I realise that I might need to dive a little bit deeper into some of these plans with all of us over the next week or so. But there you go. Yeah, absolutely, Alison. And you know what? Like, this is one of the things that we underestimate, folks. You know, we spend a huge amount of effort, which is often disproportional to the outcome, you know, really, you know, focused in the first 1 to 5 years of owning a property, right? We do. It like that sort of, the first 1 to 5 years of getting your mojo on is really full on. But once you own it, once you have it, you know, and the property is completely capable of paying for itself on a principal and interest loan, right? So we all know that the first 5 years, you know, should be interest only. That gives you more capital, that gives you more cash flow. At some point, you know, when it's appropriate, let those loans kick into P&I and they pay themselves off. They pay themselves off, folks. Like, the longer you own the property, the wealthier you become and the more cash flow you receive. It's awesome. It's awesome. It's amazing. And what happens is, because, you know, it's so intense at the start, we forget about the back end of it, right? So it's awesome that you've got that still on your radar, Alison. Even though we're doing the hustle at the front, we know that the back end, you know, the back straight of this race when we're owning our real estate is going to be a little bit more comfortable than the front part. But anyway, that's when we're a little bit less interested in taking risk, I suppose. And we want things to be a little less stressful. So there you go. And not rely on your job and careers and all that sort of stuff anyway, you know. So there you have it. Anyway, team, there you go. Again, overestimating. I couldn't even get through the 7 plans with one model today. But anyway, there's a lot in it. I'm trying to condense it. But, you know, it should be simple, but there's details in and around what we do. So, all right, team. You guys be good, be awesome, be well for the rest of your day. Thanks for joining me. Join me tomorrow. And we'll finish the models, and then I'll circle back to the 7 plans and dive deep into them, Trace, and we'll talk about the lending plan. All right, so stay tuned for that one as well. There you go. That's it. The king of chit chat. Look, it's like you should hear the team when they're saying like, "Oh, what are we going to do at mentoring?" Jason, have you got? You do 15 minutes. I'm like, team, I can't even bloody say my name in 15 minutes, let alone teach something. Anyway, it's a bit of a running joke. All right, team, you're awesome. Thanks for joining me. You guys have a good day. Adios. Bye bye. Be good. See you tomorrow. Bye.